Has the conflict in Iran become the Grinch that stole the housing market's Christmas? This is Dennis Wells. I am a mortgage advisor, a housing market crash survivor, and the host of the Faith and Funding podcast. Here is your weekly national real estate market update for May 2nd, 2026. To my shock, housing demand grew noticeably last week, even though the war with Iran continues and mortgage rates are higher today than before the war started. Everything, though, we want to see in our weekly tracker for a healthy, positive housing market happened last week. We have had a lot of dramatic events in 2026: an epic snowstorm, headlines about layoffs and AI taking all the jobs, and most notably, the war with Iran. But so far, the housing market has weathered these storms as well as it could have. This weekend, the data shows that last week was clearly an outperforming week. Let's take a look to see what is going on. First, we always want to look at weekly pending home sales. Our weekly pending home sale data provides a week-to-week perspective, and although results can be affected by holidays and short-term fluctuations such as the Easter weekend 2 weeks ago, we chalked up the housing demand recovery to the Easter rebound. But last week, there was a noticeable pickup in demand in our weekly pending home sales data. That data is at a multi-year high for the calendar week. Now, maybe some of this is a rebound from recent mortgage rate declines. However, I'm not sure that we can grow much from these levels, as this is a multi-year high in weekly pending sales, but it will be exciting to watch in the coming weeks. Weekly pending sales usually take 30 to 60 days to hit the actual sales data. Typically, mortgage rates above 6.64 and those breaking over 7% really impact the data negatively. Under 6.25 has been the sweet spot over the past several years, excluding some short-term variables. Mortgage rates did get close to 6.25 recently, but they're not quite there yet. So we look at the pending home sales last week over the last 2 years. This week, 80,258. Last year, 67,892. We also want to look at mortgage purchase application data. Purchase application data is a forward-looking indicator. Growth here leads home sales by roughly 30 to 90 days. Last week, we saw a 10% week-to-week gain and a 12% year-over-year increase. That's a nice snapback here from the softer data driven by higher rates due to the Iranian conflict. Mortgage rates have recently fallen from a high of 2.64 to around 6.29, so that was definitely one factor in this positive move. Now, new listings. Last week had the most exciting new listing reports for us in a while. We have been waiting for a normal year in new listing data for years, which means we would have at least a few weeks where this data line just trends between 80,000 and 100,000 new units a week. This level was normal between 2013 and 2019. Last year, we got above 80,000 for a few weeks, but we couldn't grow past that. Last week, we rose above that level, and I hope that we can grow from here. Some context for those who think the sky is falling anytime we get growth in new listings. During the housing bubble crash, new listings ranged from 250,000 to 400,000 new listings every week for several years. So here's the last week's new listing data for the past 2 years. This past week, 83,395 new listings. Last year, 69,891. So we're doing much better now than we did last year. Housing inventory, another huge positive for me this week. Inventory growth. We were on the verge of heading into negative territory with lower new listings data, which is not very healthy. And while inventory growth has slowed significantly from last year, it is still growing. Higher weekly pending sales, higher new listings, and higher inventory are a great sign. This is about as good as it gets in the housing market. Inventory growth is running at 4.98% year over year, down from 33% last year, but this week was a big victory for us. When we look at weekly inventory change over April 17th through April 24th, inventory rose from 743,000 to 765,000. That same week last year, inventory went from 719,000 to 728,000. Now we want to look at the price cut percentage. The only thing that could have made this update perfect would have been the price cut percentage being flat at least. But it did take a slight decline, as demand has had a nice kick recently. Typically, about 1/3 of homes undergo price reductions before they sell, which reflects the dynamic nature of the housing market. Price cut percentage is lower than last year and has been that way most of this year. And this week's decline kind of caught my eye. The price cut percentage for last week was 34.22%. In 2025, it was at 36%. Now let's talk about the 10-year yield and mortgage interest rates. As crazy as it sounds, even with all the nutty headlines about the Iran war, Jerome Powell, Kevin Warsh, and inflation, mortgage rates didn't move much as spreads have kept volatility in check. For now, as long as the Iran war doesn't worsen and the labor data doesn't improve too much, 6.64 might just have been the high of the year for mortgage rates, and the 10-year yield at 4.48% could be the top. Mortgage spreads remain a positive story for housing in 2026, as mortgage rates would have easily been over 7% in 2023 and 2024, and close to 7% in 2025, given the current 10-year yield level and the worst spread levels back then. Spreads have improved over the last few weeks, almost getting back to the lows in 2026, which is a multi-year low at that. Historically, mortgage spreads have ranged from 1.6% to 1.8%. Last week's spreads closed at 1.93%, down from 2% the week before. However, it is always important to compare last week's rate to the worst levels of the spreads over the past 3 years, given the 10-year yield's current level. If we had the worst mortgage spread levels of 2023, mortgage rates would be 7.5% today, not 6.32. If we had the worst levels of 24, mortgage rates would have been 7.12 today instead of the 6.3. And if we had the worst levels of 2025, mortgage rates would be 6.93% today. So those mortgage spreads have really done a lot to keep interest rates very stable, even through the midst of a lot of uncertainty in the market. Let's take a look at the week ahead. We're looking at Iran and employment and inflation, right? So on Wednesday, this next week, we will receive the ADP National Employment Report, as well as the job openings and labor turnover report. This is important because labor is key to what the Federal Reserve is looking at when they make their rate decisions. Friday is another big day as we will receive the Bureau of Labor Management, BLM, jobs report for April. If employment comes in weak, interest rates may improve. However, if labor comes in strong, interest rates could drift upwards. Another wrinkle in this scenario is that we are starting to get to the point where food inflation will start to creep in to some of the data lines. The longer this war goes on, the more inflation will hit some of the data. Hopefully, we'll get some closure on this topic soon. Thank you for joining me today on this video. If you have found this valuable, please subscribe to my YouTube channel and forward this video to any friends, family members, or coworkers you feel would also benefit from this and find it of value. Hope you have a wonderful weekend. This is Dennis Wells, a mortgage advisor with the Wells Funding Group.